Kia ora. Ron Montgomery from BlackRock here again. In the previous month for May, we talked to a moderation in returns. Unfortunately, that moderation didn't carry over into June. Returns across most asset classes, except for gold and cash, were negative. Equities quite meaningfully so. In June, markets started worrying more about a broader, more imminent growth slowing. The forward-looking aspect to markets shifted from a more inflationary focus to concerns around future growth. We note that commodity prices such as oil and iron ore were materially weaker in June, and market expectations for long-term inflation rates fell considerably, both of which are consistent with falling growth concerns on the back of weaker demand globally. One might be tempted to think that this expectation for falling inflation and cooling growth might temper some of the hawkish rhetoric coming from central banks. So far, we've got little evidence on that front. Central banks continue to be determined to ensure realised inflation cools, reducing those increased price pressures that all households are feeling. Moreover, a key vulnerability for equity assets remains reasonably robust earnings expectations for US companies for this year and next. Any disappointment or downgrading in earnings could be a further catalyst for weakness. More relatively speaking, some of the changes or tilts we've made have helped to moderate the negative returns somewhat in June. Having a decent amount of our global equities exposure unhedged was beneficial, thanks to a weaker New Zealand dollar, stronger US dollar, as was having a moderate allocation to gold against the New Zealand dollar, which was added to the portfolio earlier this year. Given where equity and fixed income markets are now, the forward-looking returns for investors are more positive than they were 12 months ago. We'll continue to monitor these market dynamics and can adjust the portfolios should we think potential outcomes warrant it. Thanks for listening.